529 College Savings Plans. We're covering the basics for beginners.
You have kids, they grow up, and before you know it, it's time to plan for college.
Where do you start?
How much is it going to cost?
Will you qualify for financial aid?
Should you be looking into scholarships?
When will you be able to retire?
What about student loans?
The list of questions is never ending. The good news is, all the answers are right here. Welcome to the Taming the High Cost of College podcast. Here is your host, certified financial planner, Brad Baldridge.
Hello and welcome to Taming the High Cost of College. I'm your host, Brad Baldridge. Today we have a great episode with John Munley again. Today we're going to cover the very basics on investing and 529s. So if you're a beginner investor and you don't have a lot of confidence in how to work with a 529, this episode may be for you. If, however, you've got a lot of advanced planning under your belt, you've worked with IRAs and 401ks, and you understand mutual funds and stocks and bonds and that type of thing, this may be a little bit basic for you. It may be stuff that you've already learned over the years. You're certainly welcome to continue to listen. But again, this is really targeted to be the very basics on what people need to understand in order to invest in college. Now, 529s have a lot of pros and cons, so we have all the disclosures at the end of this episode. But just be aware that 529s do have some benefits, and they certainly have drawbacks as well. And we cover some of that in all these episodes. And also, it's all covered in the disclosures at the end of this episode. As always, show notes and a lot of great resources are available at our website at tamingthehighcostofcollege.com. We've got scholarship guide for busy parents, a college money report that can help you figure out how much college might cost for you. And that may help you, of course, figure out how to do 529 planning as well. And lots of other great free resources. So head on over there, sign up for our free newsletter, and again, get lots of free resources. All right, let's go ahead and jump into the interview with John Munley. All right, John, we're back to talk more about 529s. How have you been?
Excellent. And glad to be back. Thank you, Brad. And hopefully everything's doing well out by you.
Oh, yeah. So we're going to do 529 for beginners today. So we're going to talk about things that are pretty basic. So if you're a seasoned investor, you can put this on fast forward or just breeze through it or skip it all together, because most of the more technical is going to be in the other 529 programs that we have. So this is designed for somebody that has not been investing their whole life or doesn't understand a whole lot about how the very basics of investments work. So, and again, everybody starts somewhere. So let's jump into it a little bit. And, what's your advice for someone that's just getting started in investing in general, and then 529 specifically?
Well, I think what we're doing right here is perfect. It's kind of knowing what is investing, what kind of instruments do I have to actually start investing, what are returns, how do you diversify portfolios, what is a risk component of all this. There's a lot of different things that go into making investing decisions. So I think, what we'd like to do here is break them down so everybody has a good understanding of what these different things are and how they affect, at the end of the day, what you're really looking for is a rate of return on the portfolio that you've created.
Right. Absolutely. So I think a great analogy would be that, a 529 basically is kind of very similar to a retirement plan that you may have at work or an IRA, where you're doing investing in those types of accounts as well. And it's designed for retirement where you get tax benefits and that type of thing. And then you have choices to make, especially like at your 401k. Typically, they give you a menu of, 10 to 50 options, depending on where you work and what's out there. And then you get to pick from the menu, which, of course, now ideally you kind of understand what your choices are and which ones make sense. It's almost exactly the same with a 529. Once there's the mechanics of actually opening the account and giving them your socials and, picking an owner and a beneficiary and all the stuff we covered last time. But now we're going to get into the basics around, well, how do you choose an investment, or what do you look out for, and that type of thing, because that's going to be the next step, right? Is you decide you want to save $200 a month for each child, and then you set up the 529, and that part's, again, not that hard. It's you go online, you put in your names and addresses and socials, and it's owned by a parent, and it's for the benefit of a student. And then they're going to ask you, where do you want the money to go? And there's a whole list of age-based this and aggressive growth and small cap and international funds and guaranteed accounts or CD accounts. And there's all these different choices. So that's what we're going to talk about first, I think, is what all that stuff means. And not only is this part of it applicable to 529s, but it's very applicable also to all your investing, your 401ks, your IRAs, all those things. So I guess, what are the basic building blocks? Let's start there for a typical investment.
Basically, for simplicity's sake, there's three options. You can own a stock, own a bond, or have money in cash. And what's the difference between them? If you own a stock, so you own an individual company, let's say Apple, you actually have ownership in that company. So when you say I have a certificate or a stock certificate, or I own Apple, you are an owner of Apple. With bonds, you don't own the company, but you're lending that company money. And when you lend that company money, they're giving you a return on that money. So companies, if they have to raise money, they'll put out bond issues. If you like the return, you like the company, you like the risk of the company, you're able to purchase that bond. You're essentially giving them that price that they're asking for. So let's say a bond is $10,000. You're giving them $10,000. They're giving you a return on that money, but you have no ownership in that company. And with cash, you're just keeping it all to yourself, whether it's in a checking account, savings account, under your mattress. You're not giving it to anybody. That's yours and you're keeping it. So,
right.
And that's where you can expect the lowest rate of return over time.
Right, exactly. So stock allows you to invest in the market. And of course, bonds, you're also investing in the market, just a different market. So I guess that's another clarification is people talk about the stock market. And in reality, depending on how you look at it, there's many stock markets, right? A very common market that people talk about all the time, and we're going to talk about as well, is the S&P 500, which is 500 of the largest U.S. companies. And they kind of track that as a indicator of how stocks are doing. And you can even invest in those 500 companies through various instruments and that type of thing. But it's all the big names we were all familiar with, the Apple and Walmart and, the oil companies and et cetera, Microsoft, all the tech, but also some of the boring companies, Procter and Gamble and Boeing, and some companies that, we use every day are in the S&P 500. So let's talk a little bit about that. So I have a chart in front of me, and it shows the rate of return for the S&P 500 over the last 42 years. So it starts in 1980 and goes through 2021, which is the last full year. And it shows the rate of return had you invested in the S&P 500, which again is diversified into a whole bunch of different stocks. But the actual rates of return are all over the map. From the lowest year would have been 08 at minus 38%. So had you invested $100, you'd have $62 after that year. And then the best year is 34%. So if you invested $100, you'd have $134 at the end of the year. And every year, all kinds of numbers in between. So if I kind of started in, say, 90, and it was like -7, up 26, up 4, up 7, -2, up 34, up 20, up 31. And then we get into the we get into the tech crash in 2000, -10, -13, -23, and then up 26, down. And then we get 2007 is down 38%. That was the big drop around the mortgage crisis, and so forth and so on. So if you add them all up, if you had just invested for those 42 years, your average rate of return would have been 9.4% long term. So that's a pretty decent rate of return. But as you can remember from all the numbers I just talked about, you very rarely actually got anywhere near 9%. you had some minus, 10, 20 numbers, and you had some up, 0, 10, 20, 30% up. And it averages 9.4%, because in general, there's more ups than downs. If we look at this, there's 32 of the 42 years were positive, 1 was 0, and 9 were negative. So there are, negative years and there are downturns, but over the long haul, if we can stay invested, 5 years, 10 years, that type of thing, it's relatively likely, at least historically, and again, nobody can predict the future for sure, but if it acts anything like historical, then, we generally are positive over a 3 or 5 or 10-year number. And the longer you can invest, the more likely it will be positive. So that's great news for young people that are a long, long ways from retirement. Put it in the stock market, maybe diversify it, that type of stuff we'll get into. But it's very likely in 20 and 30 and 40 years, you make money. Again, unless, there is no guarantee. Nobody can predict the future for sure. Maybe, life as we know it will change, but it's, again, probably the only reasonable option for most people is to use some form of investments in order to build for their retirement and or college.
Brad, Dimensional did a study on this exact thing that you're talking about. They looked back from 1926 out to 2021, and they looked at 2 periods of time, every 10 years and every 15 years. So you'd go like 1926 to 1936, 1927 to 1937. Every 10-year period outside of 2 always had a positive return with the S&P. The only 2 down years was 1998 to 2008 and 1999 to 2009. And they were both under down 2%. And there you had 2 major crises. You had the dot-com bubble in 2000. You had the mortgage crisis in 2007. So you had to sit through a lot of pain in those 10 years. But even then, you pretty much came out flat. When they looked at 15-year time periods, there's never been a down 15-year time period. So like you were saying, we don't have a crystal ball. We don't know what the future holds. But based on the past, the longer time period that you have, the more you're able to generate a positive rate of return.
Right.
When you're investing.
Right, exactly. So when I'm working with families, we talk about, well, maybe the stock market will return 8% or 10% or some number in that neighborhood. Is kind of the assumption as we're doing things like retirement planning and that type of thing. So do we know that for certain? Of course not. But we need to start somewhere. And that seems like a reasonable assumption based on the fact that it's, 9.4. And you see a lot of averages at various time periods and various stock markets and that type of thing. And they're often, 8, 9, 10, 12, something in that neighborhood. Again, some years are better than others and some time periods are better than others. But that's one building block that we've talked about. So that's stocks. So that's the one that, I would say the roller coaster ride of the stock market is the wildest. It goes up the most, goes down the most, can have some very sudden twists and turns. But if you can stay in your seat, it's probably worth it. Next, we have the bond market. So can you explain a little more about what a bond is again? I think you just mentioned it briefly, but so what is a bond and why do we care about bonds?
Sure. So with a bond, you're actually lending money. So you're giving your money to a company or in terms of a bond mutual fund or ETF to a group of companies, and you're expecting a rate of return back for lending the company the money. With stocks, unlike stocks, you're not in for that much of a wild ride. They definitely have lower risk than stocks, and we'll show an example of this in a little while. But it's really bonds are kind of used as an anchor to your portfolio in terms to dampen risk a little bit. And again, their rate of returns are historically going to be lower than the stock market again, but you're taking less risk. So you shouldn't expect as high a return as when you invest in stocks. But it's kind of a way between rather than sitting in cash and getting no return or just a small return, it's a way to lend companies money and be able to, expect a higher rate of return. And again, the riskier the company, the more rate of return you should expect. How bonds actually move around is based on where interest rates are going. So if interest rates are moving higher, you'll still get your rate of return, but that price of that bond is going to be worth less. So let's say interest rates go up a percentage point and your bond was worth 100 when you bought it. When that interest rate does move up, that value will go from 100 down to 93 or 94. So you will lose some money, but because you're getting a return on that, you will get return on the initial investment that you made.
Right, exactly. So that's the way you think about it. Is if I got a bond, let's say I got a John Munley bond, and you promised to pay me 5% interest. So I give you $10,000, you pay me 5% interest, but then rates rise, and now John Munley's saying I'll pay people 10%. Now, if I want to sell my 5% bond when someone could go directly to John and get a 10% bond, nobody's willing to buy my bond for what I paid for it. So I'm going to have to sell it at a discount, essentially. And if I sell it at a low enough discount, anybody would buy it for $1. So somewhere between $1 and what I paid for it is a fair price. So that's the bond market, where just like stocks are bought and sold every day, bonds are bought and sold every day. So there's the way the instruments themselves work, and then there's the way that the markets react. Stocks tend to react to things like how well the economy is doing and how well companies are being profitable. Bonds tend to react to interest rates and what's going on there, again, because that's what people are concerned about. If I can get a bond over here for 6% or a bond over there for 4%, that's the comparison. And then, of course, the last thing is cash, which again is money in the bank. The bank has a lot of nice FDIC guarantees and stuff, so the money's very safe. But as we all know, banks don't pay a ton, and especially in this environment where maybe we can get 1 or 2% on CDs and 0.5% or 0.25% on our savings account or whatever it might be. So we're not making a lot of money by having the money there, but we know the money is relatively safe and may be appropriate for at least some of our money as well.
And the one downside with cash, it's great to have cash because you have it there, but the purchasing power as years go on, that cash most likely does not keep up. The return you get or the interest that a bank pays you most likely will not keep up with the growth of inflation. And if it doesn't, something that costs $100 today may cost 10 years from now $120. You still have that $100. It doesn't have the same purchasing power as it will in 20 years, which is why a lot of people invest in the capital markets, again, stocks and bonds, because they want to at least keep up with inflation to keep their purchasing power, keep up with the inflation rate that's going to happen throughout the years.
Right.
There's a study like the whole McDonald's study. I forget what it is, but a Big Mac that cost 20 cents in 1960 versus now, whatever, I don't even know McDonald's, but let's say $5. It's the 20 cents that you had back then. You can't buy a Big Mac now with that money. So again, you want to make sure you're able to keep up with the rate of inflation when you're making investments.
Right. And if we're parents of teenagers, we all can talk about, I can remember, as an example, getting 5 donuts for $1. I can remember 25-cent candy bars. I can remember going to a movie for $4.50, and now obviously those prices are much higher.
And let's come back to colleges, which we're talking about with 529. I remember when I went to college, it was $12,000 when I was a freshman, and now the same college is $75,000. So inflation has definitely taken its toll over the last 30 some odd years.
Right, for sure. So, and that's where, again, a lot of times the stock market is a better way to fight inflation, and cash is a way to minimize risk. So we got to find a balance. And that's what's important, I think, is when I'm working with families, a lot of the times we're doing all the above. We have some money in the stocks, some money in bonds, and some money in cash. especially if college is imminent, right? If you've got a high school senior or even junior and you're saying, well, college is very close, you might have some of your money tucked away in cash just so you know it's there when you need it freshman year. But then the money that you might have for the youngest in your family, who might say is in 7th grade, and we know college is 5, 6, 7 years away. And now all of a sudden we've got more of a time horizon where we might choose to invest a little more aggressively. Now, the other thing we need to talk about is diversification, because diversification is built into most 529s, but I think it's important that you understand it. And there's diversification a couple different ways. So as we mentioned, we got the stock market where you can go out and own a stock of a particular company. So I like to use the example of Facebook because there's a story that most people can remember, but you could go out and buy individual Facebook shares and say, I own Facebook. And had you done that when Facebook first came on the scene and you still owned it today, it would have been a great investment and you would have made a lot of money. But there was a time when there was not just Facebook, but there was also that company called MySpace. And there was a time when they were neck and neck, and you had, some people were doing one and some were doing the other. Some people were doing both. Obviously, MySpace didn't make it, and Facebook kind of won that war, so to speak. Now, you could have just as easily said, no, I believe in MySpace, put all your money in MySpace, and essentially lost it all, or a vast majority of it. That's where diversification comes in, where, again, if you invested in an S&P type of fund, it would spread your money across all 500 companies in the S&P. So now any one company is not much of a risk anymore because it's only a small piece, right? So if MySpace was in the S&P and it went bankrupt, you still have 499 companies to go. So yes, it hurts a tiny bit, but it's well diversified and you don't even notice it. And again, big names used to be in the S&P 500 that are no more today. Kodak and Sears and a number of different companies were big stalwarts until they weren't. And that's where I think, especially if you're a beginning investor, there's in my opinion, no reason to go and try and figure out which stock to buy. I think you're better off diversifying across many stocks by using either mutual funds or ETFs or other financial products out there that automatically, and again, 529s do this automatically as well. They have stock funds and bond funds and cash accounts, but they're all diversified across many stocks for the stock funds, many bonds for the bond fund, and often many banks for the cash accounts. So,
and I think a good thing to remember about it is you're not only, with the S&P, you have 500 of the biggest companies in the US, but you're also investing across industries. So in a given year, you may have healthcare industry does well, but software doesn't. So you're exposed to all different industries also. So again, that just increases your diversification. It's not just the companies, but it's the industries that they're in, because in a given year, certain industries are going to perform better than others.
Right, absolutely. And that's one way to diversify, right? Is when you buy a particular fund that says, we're going to invest across 100 stocks or 200 stocks or 500 stocks or whatever choices you have there. Another way to diversify those is not to diversify the types of stock you own, or even mixing stocks, bonds, and cash. So you can, choose a fund that invests in the S&P 500, which is 500 U.S. companies. Then you could choose another fund that invests in international companies. And at different times, they do different things. And because you have, not your eggs are not in all one basket. Now, some do well, some don't do well. And on average, you do okay. Now, that's the downside of diversification, right? If you want to become a multi-billionaire, you need to do it like Bill Gates or Mark Zuckerberg, where you put all your money in Microsoft or all your money in Facebook and let it ride and let it ride and let it ride. There was a time when these billionaires had only had 100 million, and it was probably concentrated in their company. And what did they do? They said, well, let it ride. And then it got to 1 billion. And they said, oh, let it ride. And then it got to 10 billion. And let it ride. Now, that's not prudent. And I'm hoping, and most likely some of their financial advisors were having them, peel off 100 million and put it in cash or something here and there so that they would, never be truly broke. So that's a way to hit a home run. But then you get to the MySpace example of, I don't even know who founded MySpace. He's not famous or at least not as famous because his company didn't thrive and do the fantastic.
But you can also see where diversification works if you look at Warren Buffett. Like, he looks at undervalued companies across multiple industries and he'll buy different companies. And granted, he's got a lot of money to go and buy these different companies in large blocks, but he's over the course of the year, him and Charlie Munger have always followed a philosophy: find companies that are valued and that are undervalued right now. And hopefully, down the road, they're going to be much higher priced, which, not to complicate what we're talking about, but we've been talking about the S&P 500, but when you look at stocks, they're broken down into different categories. There's large cap, mid cap, and small cap, and that's based on the market capitalization of those companies. But then you also have growth and value stocks. Growth stocks are well established, and it makes it harder for them because they've always got to keep up with their expectations and what's expected of them, where value stocks are, they're not quite where they need to be yet, but they have the potential. So there's all different ways to invest in stock markets. And like Brad was saying, diversifying amongst everything is the best way you get exposure to all of it.
Right, exactly. And then the second way to diversify would be to say, well, some stocks, some bonds, and some cash. So a lot of times, in retirement or even in your 529, you might say, well, there's funds available that might be, say, 60% stock and 40% bonds, or there might be a choice that's 80% stock and 20% bonds. And then there's some that are more conservative that are mostly bonds and a little bit of stock. So that's another way to take some volatility out. I think we've got another study that would make sense to talk about now, which is kind of expected, the Vanguard study. And so Vanguard built portfolios with 100% stock and another portfolio with 100% bonds. And again, they didn't actually, and they used indexes. So they went and looked at the history and said, well, we're just going to follow some historical numbers. So this is not an actual investment. You can't actually invest in it, but they went back and looked at the various returns, and they actually started all the way back in 1926. So they pulled the historical data from 1926, and the study ended in 2019. And the 100% stock portfolio, its average return was 10.2%. Its best year was 54%. Its worst year was minus 43. And it had 26 losing years out of 94. So the other study we talked about had 9 down years out of 42. When we expand it and include things like the Great Depression and in the 30s, now we have 26 out of 94. So roughly a quarter, a little over a quarter, about a third are down in that time period. And the best year and the worst year, by the way, happened to be in 1931 and 1933, which, again, during the Depression, the stock market was very volatile and had both good years and bad years. On the other end of that spectrum, the bond portfolio did 5.3%, and its worst year was minus 8%. So dramatically less volatile as far as on the downside. And there was one good year at 32%, which was definitely an outlier, but it can happen here and there in both the stock and the bond market where you have a sudden change. And then if you just mixed it up and if you went 50-50, well, you kind of get somewhere in between. So if you were 50-50, you would average 8%. So again, all bonds, 5%, 50-50, 8.2%, all stocks, 10% on average over that whole time period. But the best year is 36% and the worst year is minus 23% in the 50-50, which also is less of a roller coaster ride than 100% equity for sure. So a lot of times people add bonds to reduce the volatility a little bit. And I think that makes sense, for some, both for retirement and for college. And again, you don't have to do 50-50. You can also do 70-30 or 80-20. So there's all kinds of different mixes out there that might be appropriate.
And I think people listening to this right now are saying, okay, Brad, okay, John, this is great, but how do I know if I'm 100% fixed income? How do I know if I should be 100% equity? And that all comes down to risk tolerance. And there's basically three components to look at when you're looking at your risk tolerance. And that's something that we've both touched on a little bit here is your time horizon. So how long you have before you actually need the money, your risk need. Do you need to take a lot of risk? For instance, if you have a newborn and you're putting $5,000 into a 529 plan, you need that money to grow and you have a long time horizon. So you may say, you know what, I have the time horizon and I need this money to really grow. I'm going to put it in 100% equities because I know historically that's had the highest rate of return. And I know over a 10-year period, I most likely am not going to lose money. But the third component, and this is a hard one for people, it's the ability to take risk. Are you the type of person who has CNBC on and if the market's down 2% in a week or 3% that you lose sleep? If that's the case, you probably don't want that risky of a portfolio because you don't want to be following it up and down and all the different gyrations that the market will take. And if that's your personality, you'll sleep a lot better having a less risky portfolio where you'd want to supplement the equities with bonds and cash.
Right. Absolutely. So that's the basics on investing. The other important piece of the puzzle is a lot of times people talk about what is the rate of return of a Roth IRA, or what is the rate of return of a 529? And we need to just mention that the 529 or the Roth IRA or IRA, all those are tax wrappers around an investment. So the rate of return is based on what you choose inside the account. So the rate of return is based on whether you choose stocks or bonds or a combination or cash or whatever it is. If you put cash, if you put a savings account inside a 529, you're going to get savings account like returns. And if you put a S&P 500 inside a 529, you're going to get S&P like returns. So the return is based on the basics of the investments, the building blocks that we've talked about. What the account does, like a 401k or a 529, that determines who has control of the account, what the account can be used for, penalties if you don't use it properly, all that type of stuff. So obviously, we've got things like 401ks and 403bs at work that are designed to help us retire, and IRAs and Roth IRAs that we can do personally that are designed mostly for retirement. And then we've got 529s and Coverdales for college. And then there's all kinds of other types of accounts out there as well. But those are the basics. This is the basics course. So let's start there for now. And you can kind of go on from there as you learn more. And then finally, let's talk a little bit about financial journalism and the overall markets, because I think a lot of beginning investors have preconceived notions, a lot of times based on what they see in the press, or maybe they invested a little bit at work once and had a tough year right out of the gate. So it's like, okay, never again. Stock market doesn't work. I mean, I hear lots of people saying things like, well, stock market's just like gambling, all kinds of things like that. So I think financial journalism comes into play because there's a lot of people out there that write about the markets, and their number one goal is to get you to click on their article. So generally speaking, they need to write a headline that's going to get your attention. Another boring day in the stock market, click here, doesn't work. They have to sensationalize it and give you reasons to be scared. Again, fear sells in the stock market, so they tend to focus on that as well. So even in good times, they try and find some black cloud somewhere that may or may not come to fruition. But again, it's something that will get a click, and that's their goal.
And I have a perfect example for this. Just remember, nobody has a crystal ball, and everybody who is giving advice is getting paid. And they can't say, I don't have a view. Perfect example. Before I got into this wonderful career with helping families through college and financial planning, I was a currency trader on Wall Street. So we had economists, we had strategists, and they had to come up with recommendations. A lot of times they didn't have a view. They didn't have an idea of where the market's going, but they're getting paid to tell clients and customers, this is what we think is going to happen. So even if they did not believe it, they had to say something. So just remember, a lot of the things that you're hearing, people are getting paid to say, and they're looking to stir up interest. So it's kind of, again, remember your risk tolerance. If you have a long time horizon, you don't care about the noise. Just block out the noise. Again, if you're somebody who just can't, then you probably want to have less risk exposure. So less equities, more cash and bonds. Really, it's kind of how your personality is.
Right. Absolutely. So then, right. So I found a piece from JP Morgan where they talk about all the different things that were going on. So, again, some examples, in 2005, we had Hurricane Katrina, 2007, the subprime blowout. We had the financial crisis in 2008, flash crash in 2010. The S&P was starting to downgrade the U.S. debt and whether the U.S. would be able to afford to pay off their own debt. And the Greek debt was in trouble. We had the Ebola pandemic in 2014, the Brexit in 2016, trade wars and inflation scares in 2018, obviously COVID in 2020, Omicron in 2021. So there's all kinds of reasons. And sometimes the markets did react to these and sometimes they didn't. And actually, we don't even know that the market reacted to these particular things or if they just reacted to something else. That's another interesting, journalists are love to say, well, the markets are down today because XYZ. And it's like they have no idea why the markets are down, but those two things happen at the same time. So they assume that they're together, which isn't necessarily the case. But so there's always reasons to not invest. But over that time period from 1999 through 2021, the cumulative return was 400%. More than 400%. So your money grew. If you put in $100 in 1999 in the S&P, it would have grown to over $400 by the end of 2021. So again, that's that cumulative rate of return of 8, 9, 10% year after year after year. But of course, we don't get it all in 1 year, right? We get 12% 1 year, minus 3% the next year, up 26% the year after that, down 10 the year after that, but generally more up than down. So we made, a good rate of return over those years when there was always something bad to talk about.
And the other thing that generally happens when people trade off of the news is it's easy. Let's say you own equities and there's negative news out and you say, okay, I'm going to sell out of my equities. I just want to go to cash and I'll buy back in on the bottom. Well, if somebody can always tell me where the bottom is, I wouldn't be sitting here right now. And I don't think you would be sitting here either, Brad.
Right.
You don't know where the bottom is. You don't know when the market's going to turn. You don't know if the market's going to bounce up 10%, then drop back down 20%, or it's just going to keep going straight up. Again, I had experience with this in 2007, 2008, with the subprime crisis and the mortgage crisis. Getting out of investments, saying, okay, this is great. I'm out. and it dropped down even more. And I'm like, ooh, I'm a genius. But then it bounced back up. And I'm like, okay, when do you get back in? When do you get back in? And you hear a lot of that from clients. So it's easy to make the decision to get out. It's very hard to make the decision on when to get back in, which again, why if you have a plan in place and a long time horizon, you kind of just want to block out that noise, knowing that over the course of years, your portfolio is going to have a positive return.
Right. Absolutely. All right. So what it really boils down to at the end is families need to make choices around how they're going to deal with this. So obviously we just spent a half an hour, 40 minutes talking about things. And now many of you out there, your eyes have glazed over. You said, oh my God, there's no way. I just am not interested. I don't want to deal with this. And some of you are like, okay, I understand. I'm ready to take the next step. Investing's not for everyone, and not everybody wants to do it, can do it. So you've got some choices, right? You can do it yourself. So you can, study the markets, learn more about it. You could take a course, or you can just jump in with both feet and try and figure it all out. But you also have the opportunity. You can also get help, right? You don't have to do it alone. You could, if you've got friends or family that can help you with it, and you feel like you can trust them, then maybe that's the course. And then, of course, you can hire someone like John and myself, financial advisors who do this essentially for a living, where we help people talk through what kind of risk are you willing to take and what makes sense, and understand all the tax benefits and all the different nuances, and build a portfolio that goes together. I think that's a challenge for a lot of people. And then somewhere in between might be just find someone that can do some spot checks to make sure that what you're doing makes sense for your situation.
And at the minimum, and two things we've been really talking about are 529 plans and 401k plans, which are similar. Most 529 plans have an age-based options. So you basically put that money in and they'll adjust it as you get closer to needing that money for college. It'll get less risky, more fixed income. Same thing with your 401k. They have target date funds. So let's say you're going to retire in 2035. You'll have more risky assets now. And, as you get closer to retirement, you'll have much more exposure to fixed income. There's inherent problems with those two, which is beyond the scope for what we're going to talk about now. But at least if you're looking to start out and don't know where to start, those are the two kind of places you can look.
Right. Absolutely. I mean, the people that run the 529s essentially say, this is what we think is appropriate for someone that has a 12-year-old or a 17-year-old or a 4-year-old. Now, they don't know the whole story. That's all they know is how old is your child and how long till college. So, again, if you might want to go beyond that, but again, that's often a place where, people will start. I encourage, again, when I'm working with families, we go beyond that, because I think the problems are real, and eventually we might move away from those once we understand what our other choices are. But it is a good place for some to start. All right. I think that covers the basics for 529s. We appreciate you sticking around and listening. We will continue on this 529 path here. So we will have a couple more episodes to talk about strategies, advanced strategies, some of those types of things. So if you need to listen to this more than once to absorb it all or take some notes, or go ahead and do that. But we appreciate you listening, and we'll see you again next week. All right, that was a great interview with John. Hopefully you've learned the basics and are ready to get started. If you're still feeling overwhelmed, as we mentioned, you always can work with professionals to help with this. I would encourage you to find a professional that understands college in more detail than just the saving and investing. Hopefully they might be able to help you with need-based planning or merit aid and all the other areas of college planning, all the things that we've covered on this podcast over the years. But again, there are people out there that can and will do it themselves. And there's some people out there who either don't have the inclination and don't want to learn how to do this, Or perhaps they just don't have the time and don't want to spend it on this, and they would spend their time doing other things instead. All right, that's all we have for today. Stay tuned for the disclosures.
Thank you for listening to the Taming the High Cost of College podcast. Now it's time for you to take action. Head to tamingthehighcostofcollege.com for show notes, bonus content, and to leave feedback for Brad. The next step on your college journey starts now.
Disclosures. The information provided to you today is for educational purposes only. It is not intended to be specific recommendations or advice. Please consult with a qualified professional before acting on any of this material. Investing involves risk. Depending on the types of investments, there may be varying degrees of risk. Investors should be prepared to bear loss, including total loss of principal. 529 College Savings Plan Disclosures. Investors should carefully consider investment objectives, risk, charges, and expenses. This information and other important information are contained in the fund prospectuses, summary prospectuses, and the 529 product program description. These documents can be obtained from a financial professional or directly from the plan's website. Please read them carefully before investing. Depending on your state of residence, there may be an in-state plan that offers tax and other benefits, which may include financial aid, scholarship funds, and protection from creditors. Before investing in any state's 529 plan, investors should consult a tax professional. If withdrawals from 529 plans are used for purposes other than qualified education, the withdrawal could be subject to a 10% federal tax penalty, state penalties, federal income tax, and state income tax. Brad Baldridge's disclosures. Brad Baldridge is a registered representative with Cambridge Investment Research. Securities are offered through Cambridge Investment Research, Incorporated, a broker-dealer, and member of FINRA and SIPC. Brad Baldridge is also an investment advisor representative with Cambridge Investment Research Advisors, a registered investment advisor. Baldridge Wealth Management and Baldridge College Solutions are affiliated. Cambridge and the Baldridge Companies are not affiliated. The registered branch location is at 10521 West Layton Avenue, Suite 200, Greenfield, Wisconsin, 53228.